The Rotary Club of Jasper is proud to host today's event and discussions from an elite panel of experts. Rotary started in Chicago, Illinois in 1905, and today includes clubs all over the globe with over 1.2 million members, including our very own Rotary Club of Jasper. Rotary is a civic club made up of people who are passionate about serving others and making things happen for the greater good by creating partnerships and aligning resources through our various personal and professional networks. Rotary is for people just like you, professionals, retirees, youth, anyone who's passionate about making a difference in their community. Internationally, Rotary is committed to promoting peace, fighting disease, providing clean water, sanitation, and hygiene, helping mothers and children, and supporting education and growing local economies. Here in Du Bois County, you might know Rotary for our annual Athena Leadership Awards, our clay shoot at OFS Cool Springs, thank you to OFS, or through our high school club at Jasper High School called Rotary Interact. We're also known for our many grant projects where our partnerships have included the local Parks Department, TRICAP, the Department of Natural Resources, our local churches, and most recently with Memorial Hospital, where we are providing a month's supply of diapers and a children's book to parents of 1,000 babies over the next year. As you can hear, the Rotary Club of Jasper is a club of action and service, and today's program is part of our effort supporting education and growing local economies. If you are also passionate about serving others, I invite you to visit our club and find out how you can get involved. Contact us through our Facebook page, Rotary Club of Jasper, Indiana, or by emailing our membership chair, Michael Olinger, at MOLINGER@that'sfreedom.bank. Next, I'd like to thank our Bull and Bear sponsors for making today's program possible. Thank you, Bull sponsors, German American Bank, Eagle Crest Financial, Kimball Electronics, WITZ, WQKZ, Old National Bank, Ken Sendelwick with Merrill Lynch, and WBDC, WJTS. Thank you to our Bear sponsors of Jasper Group, Freedom Bank, OFS, Master Brand Cabinets, Springs Valley Bank and Trust, and the City of Jasper. I'd also like to mention a special thanks to Rotarians Derek Budd and Nick Stevens for coordinating and organizing today's event on behalf of the Rotary Club of Jasper. And lastly, I'd like to thank our esteemed panelists for giving their time today to educate and enlighten us. We greatly appreciate you and your willingness to share. Our moderator today is Dr. Heidi Kessner, Dean of the Kelley School of Business at Indiana University. She is also the Frank P. Popoff Chair of Strategic Management. Her research focuses on corporate boards, executive succession, and mergers and acquisitions. Dean Kessner earned her MBA and PhD from the Kelley School of Business and her bachelor's degree in business administration from Southern Methodist University. Please join me in giving a warm virtual welcome to Dean Kessner.
Thank you so much, Christian. And I too want to welcome everyone, and a special thank you, Christian, to you and to the Rotary Club for welcoming and hosting us today. I also want to thank our generous sponsors for their support of this event. Before I introduce our panelists, I want to say just a brief word about the Indiana Business Research Center, otherwise known to us as IBRC. The IBRC is a center within the Kelley School of Business at Indiana University. Now, the Kelley School just celebrated its centennial 100th anniversary, and the IBRC has been a part of the school for nearly its entire history. Since 1925, IBRC has monitored socioeconomic trends as they relate to our state, the Midwest region, and indeed even the nation. IBRC provides and interprets economic information needed by businesses, governments, and nonprofit organizations. They have things such as Stats Indiana, which is statistics for states, counties, cities, towns, townships, regions, census tract, and more. They have Stats America, which is a portal to US data supported by the US Economic Development Administration. There's something called Hoosiers by the Numbers, which is workforce data, and Unleashing Data for Decision-Making and Research, which is a partnership of state agencies and the Indiana Business Research Center to improve the quality and usability of state data. There's Indiana Gateway, which provides information about how taxes and other public dollars are budgeted and spent by Indiana's local units of government. There's a Center for Economic Model Research, or CEMR, which provides quarterly economic forecasts for the United States, Indiana, and the Indiana metropolitan areas. IBRC has quite a few publications. In Context provides substantive, easy to read articles about Indiana's workforce and economy. It's published on a bi-monthly basis. Indiana Business Review, which has been published since 1926. This provides analysis and insights on Indiana's economic and demographic issues. And Indiana Economic Digest, which examines daily news from newspapers around the state, focusing on hot business topics. So you can see there's a lot of data that's collected, and I hope you'll turn to IBRC not only for its publications, but if you need help with data in your area. Now let me introduce our three panelists. We're going to be starting with Dr. Ellie Maffei-Kraft. Dr. Maffei-Kraft is a native of France. She holds a BS, MA, and PhD in economics. She's a clinical associate professor of business economics and public policy at the Kelley School of Business since 2006, and an affiliate faculty at the Institute for European Studies. She co-authors the yearly International Outlook for the IBRC. Her professional interests are in international economics, with an emphasis on the relationships between business, government, and society. And she is also interested in strategic sustainability. Zhenyu Wang. Zhenyu Wang is professor of business finance and the Edward E. Edwards Professor at the Kelley School of Business in Indiana University. He was formerly a vice president at the Federal Reserve Bank of New York, where he was the head of financial intermediation. Before working at the New York Fed, he was a faculty member at Graduate School of Business in Columbia University for 9 years, and he was at the School of Business of UT Austin for 1 year. Professor Wang obtained his PhD degree in economics from the University of Minnesota. And Ryan Brewer. Dr. Brewer is an associate professor of finance at Indiana University, Columbus, where he's taught undergraduate and graduate courses in corporate finance, investments, and derivatives since 2009. He's testified as a valuation expert in the US federal and Indiana state court system, and he worked for 5 years as a risk manager for a Fortune 50 company in Michigan and Indiana. He holds an MBA and PhD from the Kelley School and a BS in engineering from Purdue University. As I turn over the time to Dr. Maffei-Kraft, I want to remind all of our audience members that they can submit their questions that they have through the Q&A function, which will appear at the bottom of your screen, and I'll bring those questions to our panelists after all have spoken. Thanks.
Thank you very much, Dean Kesner, and hello to everyone at the Rotary Club in Jasper. So at a time when health officials are restricting our travel and asking us to stay home, my mission in the next few minutes is to take you around the globe, emphasizing on the US, China, Euro area, and Latin America. So last year, our group at the Indiana Business Research Center forecasted a global output growth of about 3% for 2020. But a microscopic virus came into the picture, and instead of a growth in economic activity, we are experiencing a global recession of a magnitude not seen since World War II. It is estimated that by the end of 2020, the global economy will have shrunk by 4.4%. The numbers forecasted today may not be relevant tomorrow because the pandemic, which is our greater obstacle to the recovery, is something that we have never experienced in modern times. As long as the virus circulates unchecked, growth is compromised. At any moment, a resurgence of COVID-19 infection and subsequent tightening government restriction can threaten to drag the world in an even more prolonged recession. Our group is cautiously optimistic that our estimate of a 5% global recovery in 2021 will be just enough to erase the 2020 global drop in output. So let's look at the United States a little bit more closely. In the second quarter of 2020, the Bureau of Economic Analysis recorded macroeconomic statistic never seen before. From April to June, the year-over-year decline in US GDP was 9.5%. To put that in historical perspective, at the height of the global financial crisis, in the second quarter of 2009, the GDP contracted by 3.9%. In April 2020, the US Bureau of Labor Statistics recorded a record unemployment rate of 14.7%, as more than 20 million Americans abruptly lost their jobs. It could take years to return to the 3.5% unemployment rate the US recorded in February 2020, because no one really knows what the post-pandemic economy will look like. Corporate default rates are increasing, and more than half of the small business owners surveyed by the US Chamber of Commerce worry about having to permanently close their businesses. Clearly, the pandemic has created extraordinary circumstances and new challenges for the policymakers in the United States and around the globe. It has affected aggregate supply and aggregate demand simultaneously. This two-sided market shock has consequently intensified the need for greater and more coordinated interaction between monetary policy and fiscal policy to try and minimize the economic harm. In regard to monetary policy, the Federal Reserve lowered its policy rate to near zero and increased its holding of US securities to help keep consumer credit available and borrowing costs low. Additionally, in order to continue to support the nation's recovery, the zero interest rate policy was announced to last through 2023. In regards to fiscal policy, the US Congress voted the CARES Act that provided help to families and businesses. As of now, Republicans and Democrats have not been able to agree on a renewed fiscal package in a country where inequality is rising and racial and ethnic minorities are left behind. The downside risk to the forecast in the United States is the intensifying political divisions. However, thanks to the country's structural potential, technology advancement, a very flexible labor force, as well as the flexibility of the economy and the world appetite for the dollar, we estimate growth in the United States to be above 3% in 2021. So now let's look at the second largest economy in the world, China. At the start of 2020, China experienced its first output decline in more than 4 decades and is now experiencing the slowest annual growth since Mao's Cultural Revolution in 1976. That said, China will be the only major economy with a positive growth in 2020. We forecast China's GDP to expand by 2% in 2020, thanks to a robust recovery that has not been obstructed by a strong resurgence of the coronavirus. It is projected that GDP growth in China will further increase in 2021 to above 8%. The return to growth in China has been powered by the country's state-backed industrial sector. Thanks to a pandemic that originated within its borders and left economies outside of China floundering, China's manufacturing power shifted to address the global demand for medical products and other work-from-home equipment. However, amid global backlash over coronavirus, as well as calls for inquiries from Australia, continued rising tensions with the United States on trade and technology, and a growing US-led coalition against Huawei, global demand for Chinese products is decreasing. Furthermore, South Asian countries such as Vietnam, with a lower wage environment and less trade risk, are emerging as a more attractive trading partner in the global supply chain. Nevertheless, it is important to signal that China's relative strong recovery has supported and is supporting many economies around the world. Specifically, China's stimulus-led infrastructure expansion allowed many export-led countries, in particular commodity exporters, to recover, while their service activities continues to be hampered by the resurgence of the virus. Next slide, please. Now let's move on to the Euro area. The area is divided in two zones, the North and the South. In the North, Germany and Netherlands have leveraged their large budget surpluses and robust industrial structure to strengthen their resiliency to the pandemic. However, in the South, Spain, Portugal, Italy have put the most stringent lockdowns and counted the greatest number of deaths. Their fiscal space was initially more constrained, and therefore the safety net they could offer to their businesses and their residents more limited. Furthermore, these southern economies do rely heavily on tourism, particularly in a country like France, which rely heavily on tourism, aeronautics, and luxury products, some of the hardest hit economic sector during these pandemics. The economic burden has been significant. This north-south dichotomy in the Euro area was viewed initially as the last straw to the fragile unity in the region, but unprecedented coordinated effort from the European Commission on the fiscal side and European Central Bank on the monetary side have so far supported the Euro area by limiting the economic devastation. Although we estimate that by the end of 2020, the Eurozone annual GDP will drop by 8%, the safety nets that were deployed by the European institution will remain essential to stabilize the European financial market. Likewise, the safety nets will support the nation's expenditure related to the pandemic, provide credit guarantees to firms, and support the most vulnerable household in Europe. We are hopeful that with a sustained, coordinated fiscal and monetary stimulus, the Eurozone economy will rebound and that economic activity will increase by 5% in 2021. Finally, let's look at Latin America. This region includes large economies such as Brazil, Mexico, Argentina, that represent 8% of the world population and accounts for 30% of global COVID-19 cases and 1/3 of the deaths. Many countries in the region depend on tourism, commodity exports, or capital inflows, including remittances. With commodity prices at their lowest historical level, tourism at a standstill, and remittances dropping as unemployment has risen around the world, these economies are greatly hit, impacting the region as a whole. Furthermore, this emerging market cannot increase their indebtedness without raising fear of future default. The macroeconomic tools to lessen the cataclysm of COVID-19 are limited, and therefore a return to pre-pandemic growth rate will likely take years. Adding to concern, social and political problems in the region are about to erase 10 years of sustained increases in middle-class living standards. Next slide, please. So in conclusion, in the first part of 2020, virtually every country in the world experienced a quasi-simultaneous collapse of its economic activity. Mind you, a collapse that was historically unmatched in time of peace. The swift, comprehensive, and well-targeted monetary and fiscal support is improving the prospect that an economic recovery will be achieved by the end of 2021, pending the absence of prolonged lockdowns. Some countries have more budgetary rooms to maneuver and are enjoying lower cost of borrowing. Others, with higher debt service costs, have to rely on global solidarity. This health-related crisis is highlighting the fact that our global market approach to trade that has many points of interconnectivity is only as strong as the weakest health system. Economic survival will be the focus in the short term in 2021. However, more long-term resiliency will need to be engineered in our global market going forward. So now, let's move to Jenhu, who will present the current situation in a quickly evolving financial market and also give you information on the US financial outlook for 2021.
Thank you very much, Ali. Hello, everyone. The US financial markets experienced a dramatic stress and a recovery this year. In the equity market, the S&P 500 index, as shown in the top chart, was down by 31% on March 23rd, since the beginning of the year. And then it bounced back to be up by nearly 11% on last Friday. The technology-intensive Nasdaq index was minus 24% on March 23rd, and then soared to positive 32% as of last Friday. The Russell index for small US firms was minus 41% on March 18th, and then came back to be positive 4.5% last Friday. The volatility index, which is not shown in the chart, spiked to 82 in March and then dropped all the way to 23 by last Friday. Now in corporate market, the tight spread in the middle chart was 39 basis points at the beginning of the year. And this spread measures the credit premium in short-term borrowing costs. It jumped to 142 basis points in March and then came down to barely 11 points by last Friday. For long-term borrowing costs, we saw the credit premiums of the AAA rated bonds jumped from 53 basis points to 235 basis points, and then eased to 66 basis points by last Friday. The premium of speculative high yield bonds jumped from 3.56% to 10.87%, and then calmed down to 4.62%. In Treasury bonds market, the 10-year yield remains below 1% since March, as shown in the by the bluer line in the bottom chart. The gray line shows the 2-year yield. The spread between the two yields narrowed toward zero in March, but then widened afterward. Economists interpreted the wide positive spread as a market signal of future economic growth. Apparently, that means in March, and economists don't have a good expectation about the economic growth. The break-even rate was 1.8% at the start of the year, and this rate is interpreted as the market expectation of long-term inflation. It dropped to 0.5% in March and came back to the original level in early September. Well, all of these appear to indicate a full recovery of the financial markets. This V-shaped recovery is remarkable and perhaps puzzling because the economy is still far away from being recovered. To understand this dramatic rebound and to forecast the markets next year, we must review the 3 new factors that currently dominate the financial markets. Next slide, please. Well, the first new factor is, of course, the coronavirus that impacts different sectors of the industry very differently. The top chart shows the year-to-date returns in different sectors on the Friday prior to the Pfizer's first announcement of its vaccine results. Clearly, this pandemic rewards communication and online shopping, and hammers travel, services, and energy. On the bright side, this pandemic exerts a powerful force on technological and pharmaceutical innovations. The second new factor is the extreme uncertainty about the path of recovery. We don't know whether the industry will recover to old business or has to recover to new business. The trajectory heavily depends on the development of a vaccine. The recent news about the exciting progress on vaccine gives people hope to resume some of the good old life. This has a completely different impacts on different sectors. The middle chart shows the sector returns since the Pfizer vaccine news. This chart is almost a flip of the top chart. In addition, the pandemic coincides with the political uncertainty of a contested election, which has implications to future fiscal policy, tax, and regulation. The third new factor is the extraordinary monetary policy and fiscal stimulus that we see this year. Besides cutting overnight interest rate to zero, the Fed has been purchasing $120 billion of assets every month. Breaking from its tradition, the Fed bought corporate debt securities in the summer to push up the corporate bond price. It even lends to firms directly. The Fed has increased its balance sheet from $4 trillion to $7 trillion this year, as shown by the blue line in the bottom chart. These activities completely distort the pricing in that market. The impact of the fiscal policy is also important. The Congress passed the $2 trillion CARES Act to stimulate the economy by giving loans to both large and smaller firms that are hammered by COVID. The physical stimulus sent the national debt above 100% of GDP, as shown by the yellow line in the bottom chart. It is unclear how much influence this stimulus has on the pricing of debt and equity, and nobody has a clue. The existing analytical tools do not have placeholders for these new dominant factors. With this background, we're here to do our best to forecast the financial markets next year. Looking back at the history of financial markets, I feel this is the most difficult time to make a forecast. Next slide, please. After some research, and we do see some strong upside momentum. First, with the US firms' ability to adapt and to innovate are really impressive. Even though the government failed to deliver additional stimulus in the third quarter, the GDP grew by 33% at annualized rate. As the top chart shows, this is shown by the top chart from the EBA. Okay, in the same quarter, 165 IPOs were added to the stock exchanges. And also by the same time, new business applications this year were up by 38% compared to last year. All of these shows how the resilience of the US business, the ability to adapt and to innovate. Today's Wall Street Journal has an excellent front page article and that describes how new entrepreneurs emerge from the wreck of COVID economy. Second, the acceleration of vaccine development is a very strong dose of optimism. Even if we don't settle the delivery and the distribution issues of the vaccine next year, just progress in these areas may keep the markets up because financial markets are forward-looking, and financial market will be happy to see there's an end of this pandemic. Third, with the continuing support by both the Fed and the government, we expect the low borrowing cost and the additional fiscal stimulus. The Fed has promised to keep the interest rates at 0 until 2023. The Fed chairman recently even signaled that the Fed is willing to expand asset purchases if long-term interest rates jump unexpectedly. In the meantime, politicians seem all agree that some additional fiscal stimulus are necessary, although they will continue to fight over its size and its distribution. Well, there are significant downside risks in the market. Of course, on top of the list is the risk of a prolonged pandemic and additional business restrictions. The recent surge in infection and the reinstate of the restrictions in some states in the recent days and are reminding us of this risk. Okay. Another important risk is the high valuation of equity. As the middle chart shows, the P/E ratio of SP stocks quickly climbed above 25 this year. The P/E ratios of Nasdaq stocks escalates to 40. These levels of P/E ratios are unprecedented and cannot be justified by existing valuation models in finance. By contrast, the credit risk have very low premiums, as I presented in the first slides, and Well, this is really inconsistent with the upward trend in corporate default rates, as shown in the bottom chart here. Another risk is the potential tax and regulation overhauls favored by the incoming Biden administration. And with all these upside momentum and a downside risk, the outlook of the financial markets this year highly depends on the trajectory of COVID and the actions of the government and the central bank. Well, overall, we think there are reasons to expect the risk to be contained by the momentum, the upside momentum. Well, first, any further success in vaccine and treatment may increase the hope for us to coexist with the virus peacefully. The industry's ability to adapt and innovation may mitigate future shutdowns even before the vaccine stops the pandemic. Second, if the Fed keeps interest rates low, as they promise, and continues to purchase assets and injects more liquidity into the market, the high valuation of equity and the low premium of credit risk are likely to continue next year. If these don't change, and probably the asset price won't collapse. Third, if we have a divided government in January, significant overhauls of taxation and regulation would be less likely. Although a divided government reduces the chance of a large fiscal stimulus. But the industry's ability to adapt and innovate may still carry the economy and the markets forward, like what we saw in the third quarter of this year. Therefore, well, we expect the equity prices to be volatile next year, but heading up generally. Well, let me end my presentation with this positive note, and I'll pass the torch to Ryan. Thank you.
Thank you, Xinyu. You know, I think about what we have experienced as a group over the past, say, 15 years. If you go back even farther, go back to the turn of the century, we've really experienced 3 significant financial events in our lifetimes. The dot-com issue, the overvaluation of dot-coms that in many cases weren't even generating revenues at that point. As Xinyu was talking, I was thinking about that. And then we moved on into the Great Recession, where we experienced a financial catastrophe within the banking system worldwide. And we learned some lessons there, and we used some tools of quantitative easing and interest rate changes and adjustments that worked to some degree throughout the world. And now we're in this third event, which is exogenous to the economy, exogenous really to everyone. And we've been experiencing, you know, a coordinated effort between or among companies, governments, Federal Reserve Bank and their peers throughout the world. And it's really been pretty marvelous to watch the pretty fantastic results that they've achieved collectively. So with that, I'll begin my presentation about the state of Indiana. And like the world and the United States, Indiana continues to recover from the pandemic, which did hit North America like a tsunami, very different from the Great Recession in March this year. As the waves of infection continue to move through our economy, various geographic locations and various industries have been affected at different times in different ways and to different degrees. Hardest hit have been locations and industries reliant upon significant population density, such as large cities and businesses and properties located there, travel destinations, particularly requiring airline flights, hotels, restaurants, bars, churches, sporting events, and other places people gather together. Yet while the first wave moved through these areas, it has reached the cradle of good manufacturing and production, home to Indiana. While services, especially small services companies like barbershops and dentist offices, are most subject to failure and furloughs, manufacturers are also feeling the pain. Among businesses in manufacturing and assembly, hardest hit are smaller firms, more likely to capsize, even while the life preservers of CARES Act funds are set to expire now. Some background of Indiana as an economic center. Indiana is the nation's most prolific manufacturing goods producing state, generating about 17% of GSP from manufacturing and an additional 22% of GSP from goods production, or nearly 40% of its total output from making things. Some might think of Michigan, Ohio, Pennsylvania, Wisconsin, Louisiana, or even Texas, yet Indiana leads this pack. Because we make things in Indiana, we tend to contract sharply in the early stages of a recession, and we expand quickly in the early stages of a recovery. For instance, in the second quarter of 2020, while the US fell in output by a record amount, annualized 31.4%, the Hoosier State fell by an unprecedented 33%, resulting in output losses of more than $31 billion. We've experienced recovery to some degree since then, as the pandemic abated somewhat during the warmer summer weather, and interactive restrictions were lifted at that time. For instance, during peak employment, pre-pandemic times in Indiana throughout 2019 and up through 2020 in February, we held about 3.17 million jobs, very tight labor market in the state of Indiana, and certainly down here in Du Bois County. At the height of the lockdown, Indiana had lost well over 400,000 jobs. We've recovered nearly 300,000 of them, and now we're just over 3 million jobs in the state. Yet we've remained behind when we compare ourselves to pre-pandemic levels. As we do not yet have numbers for output about the third quarter, the exact measure of the rebound to date remains unclear, although we do know that we're still down in total output from pre-pandemic levels. Currently, COVID-19 confirmed cases, hospitalizations, and deaths are spiking again here and across the Northern Hemisphere as we brace for cold weather, a time when general coronaviruses are known to oftentimes proliferate. So why did we experience this sharp economic contraction from the coronavirus? Why was it different than the Great Recession in its form, in its pattern? We self-directed this exogenous shock to gatherings. Work, family, sports, social, and other groups were prohibited. We locked down to flatten the curve. We intentionally shut the economy down to help mitigate the effects of the virus. The economic damage thus far has been swift and deep, quite unlike the damage wrought by the Great Recession. It sounds like a simple thing. Shut the economy down, and when the virus is reasonably contained, start it back up again. Yet it's not so simple. The time lag between shutting down and firing back up, in particular in certain industries, such as transportation, airlines, hospitality, and leisure, the effects result in permanent damage, with jobs and businesses lost, and former members of the labor market oftentimes left behind. We had to do it. Our healthcare system may have been overwhelmed without it, and we're currently experiencing capacity issues in our healthcare system now during this current virus spike. Yet because we now, 9 months forward from March 1st, know more about the virus, therapeutics, vaccines, and the way the virus spreads or does not spread, it is less likely we will need to entirely shut down again. However, with the virus spiking and a new administration set to begin work in January, the option does remain on the table. In fact, as was previously noted, many European countries, for instance, Austria, Germany, and France, and American states, for instance, New Jersey, Michigan, and Washington State, among others, have begun new rounds of targeted lockdowns. My best estimate is we will generally utilize other forms of virus control such as masks, ventilation, and distancing to avoid full-scale shutdowns. However, this does not mean people will go about activities like in the pre-pandemic days. They will likely not. It also is unclear whether we will experience more full-scale shutdowns or not. I'll get to who suffers and who benefits from this in a moment, but next I want to discuss the Indiana labor market. There are two components to the labor market, the unemployment and the labor force participation. I'll discuss each in turn. The unemployment rate in Indiana spiked to 17.5% in April. The US rate spiked to 14.7%. Large metro areas and vacation travel destinations spiked the hardest. For instance, Detroit got all the way up to 24% unemployment in April, and Hawaii remains at 13% unemployment now at the last reading. By contrast, cities throughout Indiana have recovered better, and unemployment is now at 6.2% across the state as a whole. Again, this beats the US unemployment rate, which stands at 6.9%. Du Bois County, as a significant producer of food and protein, benefits from a more defensive, stable economy, and the current unemployment rate here stands at 3.8%, even better. The second measure of health in labor markets is the labor force participation rate, which describes the percentage of adults either working or seeking work in a given geographical region. LFPR, as we call it, as a calculation, kicks adults out of the unemployment equation when they've begun seeking work for more than 3 months. So after they've been seeking work for 3 months, they're no longer counted in the unemployment rate, which tends to drive the unemployment rate down, but it doesn't help the labor market. Thus, ostensibly, we could end up with a low unemployment rate and a low LFPR, which would not be good. Rather, what we would want would be a low unemployment rate and a high labor force participation rate. The LFPR in Indiana was reduced by the Great Recession, which harmed the labor market considerably. The LFPR reached a post-recession rate of 65.1% by 2016 to 2018. It's down to about 63% right now. And the all-time peak in Indiana was reached in 1995, before the dot-com crash and before the Great Recession, and that was 71.1%. So each of these events tends to harm the labor market in Indiana. When the unemployment rate and the LFPR are considered together, losses across the state of Indiana since the peak labor market of 2018 have resulted in the elimination of over 100,000 workers. Of these, about 70,000 have been lost during the current pandemic of 2020. Nonetheless, Indiana, as a relatively light leisure and travel state and a relatively heavy manufacturing and goods production state, fares well versus neighboring states and peer states. As far as population growth as a means to enhance the labor market, Indiana has grown the past 10 years during the longest expansionary period on record by 3.8% to a level of 6.7 million total citizens in Indiana. As a more defensive agricultural center, Du Bois County has grown over the same 10-year period by only 2% to a level of 42,700, although it is more stable than Indiana. Next slide, please. Industries that were initially affected include travel-oriented businesses, including airlines, hotels, and restaurants. I think that's been well documented throughout these and other discussions that you may have heard. Manufacturing was also hit hard a month or so later, but only about half as hard. Industries across Indiana, including leisure, hospitality, manufacturing and goods production, education and healthcare, and retail, have rebounded somewhat, yet they've all suffered cumulative total 3.3 to 5% losses since March. Of these, manufacturing losses accounts for half of them, with 50,000 jobs lost. Additional losses will depend upon our continued responses to the virus, therapies, behaviors, vaccines, and national debt increases notwithstanding additional fiscal stimulus. Next slide, please. The last quarter of 2020 and the first quarter of 2021 will likely include output interruptions or attenuations, avoidance of which is largely dependent on additional fiscal stimulus as well as effectively developed and distributed therapeutics and vaccines. As our collective wisdom as to how to defeat the virus continues to improve, the last half of 2021 will likely show improvements to output and perhaps to a lesser extent in the labor markets. A while ago, I hinted at who will likely suffer and be rewarded as we move forward. Well, who will suffer? Big cities, major sporting organizations reliant upon large, densely populated events, socially oriented services like salons, dentists, doctors, and others performing preventive care, optional care, or elective services will suffer. These businesses will suffer relatively more until the pandemic lifts. Sadly, low-wage earners will suffer more than higher-wage earners because service jobs will continue to be disproportionately affected, and these workers will be more at risk to furlough or unemployment. Who will benefit? Places of business with less population density, small and mid-sized cities, rural communities, automotive companies, which benefit because public transportation is less in favor as it results in challenges to social distancing. Also, businesses able to continue to capitalize from the use of technology will be able to survive longer and may shape trends going forward. Indiana stands to benefit from some of these trends currently set in motion. As a state with smaller, less densely populated cities, and with a large presence in automotive and pharmaceutical development, Indiana stands to benefit from its manufacturing culture that could benefit from reshoring jobs as well. Also, we might benefit from population gains arising from migration away from large Midwest cities such as Detroit and particularly Chicago. Not sure this would benefit Jasper, but it might. The outlook for Indiana is that this coming winter, right now, and for the coming 4 or 5 months looks to be the challenge. We need targeted fiscal stimulus to help small businesses and furloughed individuals survive and transition beyond the pandemic, although this is not a guarantee. This outlook is contingent on continued good news with vaccine development and plans for effective distribution. Even so, even with vaccine continuing to have good news there, the last quarter of 2020 and the first several months of 2021 will likely be difficult as we move to get these vaccines finalized and effectively distributed. The latter part of 21 should yield strong growth opportunity for Indiana in terms of output and jobs, with manufacturing leading the way, as I am sanguine we're poised to experience strong growth in quarters 3 and 4. Thank you very much, and I'll now turn the program back over to Dr. Heidi Kesner for additional thoughts and questions and answers.
Thank you, Ryan, and thanks to all of our panelists. We did have a couple of questions come in, so I'd like to pass those to the panelists. I'm going to start with Ellie Maffey-Kraft. The question was, is a successful and mass-produced vaccine included in the national and international economic output estimates? And if so, what time frame are you anticipating for the impact of the vaccine?
Yes, thank you. The baseline projection that we have here at the IBRC assumes that social distancing will continue into 2021. And subsequently, it will start fading over time as the vaccine coverage expand and the therapy improve. So in our model, we assume that the transmission will be brought to low levels by the end of 2022. But that said, if the vaccine is available sooner, then the activity will return more rapidly to pre-pandemic activity.
Thank you. Zhenya, the next question is for you. The question is, you mentioned tax rates and regulation are part of the unknown risks that could occur under a Biden administration. What sectors do you believe are most at risk for extra regulation, and what impact will the Senate runoff election results have? These are the runoff results in Georgia. What impact will they have on the risks?
Great question. Yeah. For regulation, I think the most impact will be about the finance industry and the banking industry. And this area is actually a little bit complicated, and because mostly the Trump administration tried to rewind much of the Dodd-Frank and the bank regulation, but most of the regulations are already in there. And but they want to tightening several, like a capital requirement. That's the one thing they want to tighten it further. And there are something. Another one is the most important one is the Volcker rule that prohibit banks to trade and to do speculative trade. They have to distinguish whether your trade is for protection of the customer or service customer, or actually sort of investment for bank. In practice, it's really, really hard to distinguish them. They have to document, make a lot of documentation to support it. That's the finance industry viewed as a big burden, and but that's one that I want to go back. But on the other hand, there's another one like a fiduciary responsibility, fiduciary rule that requires the financial advisors to put the customer interest to be first. And And if your compensation is based on commission instead of fees, and that when you turn out, and it doesn't need to go through Congress or Senate, that administration can do it. And so that's really a risk. You think hard, and then it's well, the administration get in, and they will do it through the commerce department and change the rule. However, and I don't think that will affect the finance industry that heavily, because the finance industry pretty much already adjusted to the new regulation, assuming it will be there. This uncertainty, they don't like it. So most of the financial advising businesses already switched to fee-based and instead of away from a commission. So that's kind of a complicated picture. But tax risk, I'm talking about a risk for corporate tax, because the Democrats want to reverse the tax cut. I want to reverse back to the original 35% statutory tax. And that will affect all of business. And the tax cut create a huge run-up of market and a huge, and I said buyback in 2018. And that's the risk I talk about. That needs to go through the Senate. And that's why the Senate election is very important for it. And I think these are the main risks that I'm talking about in my mind. Okay.
Thank you.
Yeah.
Ryan, we have a question about, you explained why Indiana is more sensitive to economic recession in the manufacturing base we have here compared to the rest of the country as a whole. What can Indiana do to improve on this? In other words, address the extra sensitivity we have.
Thank you. That's a good question. I think for many years, Indiana has been a laggard in educational attainment at the higher educational level. We rank in the 40s in terms of higher educational attainment. We have gone all in on manufacturing, and we have a strong culture in manufacturing and a great footprint. It might benefit us right now. I think it will, as the world looks to move its supply chain with what happened with the pandemic. And I think Indiana could be a benefactor in terms of reshoring of jobs and of businesses in the manufacturing industry and in that sector. But for the long run, I think what Indiana needs to do to move away from its cyclical positioning is to develop a more intensive structure for job readiness at the higher educational level. If we continue to invest more in our children and get them on the track to college, I think that Indiana can benefit in different sectors that are more service oriented. And as we move forward in probably 5 years out, I think this will help Indiana more.
Great.
It'll also help wages go up as well. Sorry about that.
That's true. And so Zhenya, we have one more question for you. I'm going to ask it as a combined question. The question that was submitted is, can you talk about growth value disparity in 2020 and whether it will continue or reverse in 2021? And if you might, I know there are a lot of listeners also, so this was the growth value disparity, but there are a lot of listeners who are wondering what they need to do to protect their 401ks in 2021. Can you speak to that as well?
Yes, but I'd be very happy to. And it's a great question. It's a challenging question, and nobody knows has the magic recipe to make you save and still get high returns. If you want to be safe, put in the cash. And what Warren Buffett's rule said, how to build your wealth. The best way to build your wealth, don't lose money. Well, that's useless. And so actually, yes, and this year we see the growth stock and perform very well. Value stocks are hammered, but what happened is the growth stock tend to be those that are looking for new opportunities, technology stocks that can be less economically sensitive. Value stocks tend to be more economically sensitive. It turned out to be in this category. That's why we have seen this. But recently, yes, in recent days, we see value stock come back since the vaccine news, and a lot of people say that we should adjust. And yes, and it may reverse, it may not. As I said in my presentation, it really depends on the trajectory and whether we really have to adjust to the new normal and mostly, or we could resume much of the old life. And the recent as I show you that the industry, the returns across the industry basically flipped since the vaccine. And that's the uncertainty we face in terms of portfolios for 401k retirement, how to protect that and still get returns. And still the best advice, I think, the number one is the old rule, diversify. And I'm not talking, but there's some new content there. I'm not talking about diversify across bond and equity. People think diversify about 60 equity and I put a SP and 40 bond. And I personally think a bond is bad. And a bond is overvalued. There are very little upside. The interests are hard to go down, hard to go down. If it's go up, you're going to lose money. Very limited upside. If you want to stay in the bond, I would rather say go to inflation protected bond, because when inflation go out, the bond price go up. When you have inflation tick up, and you could get gains there. And in fact, this summer from April to August, there are huge inflation premium to go up, and so if you hold inflation protected portfolio, it'll perform well during that period. And on the other hand, it's really need to diversify across industry. That's the key. You don't want to really put just value or just growth and just technology. And you don't know which path it would be. Diversify across industry is number one rule. And I would like one more thing that if you want to build a portfolio and put more weight on the dividend paying stocks that tend to weather the uncertainty better. Okay, that's another advice. Last advice, and a lot of portfolio don't offer that. I use Fidelity, doesn't offer that, but some retirement offer that. The sort of the equity linked notes, which protect the principal, but gave you upside. And that's essentially equivalent to using derivative securities to protect the portfolio, but still get exposure on upside. But if you do it with the derivative yourself, it's complicated and it's costly. And if your retirement portfolio offer that product, I would recommend it's a good time to take it. That's my advice.
Thank you for helping us make money in this environment.
Yeah.
I know we're out of time, so Christian, I want to turn it back over to you. I know you have a few concluding remarks.
Thank you so much. Thank you everyone for attending today and for your questions. Thank you again to our expert panel and our moderator for sharing insights into our future. We'd also like to thank our sponsors one more time, including our both sponsors of German American Bank, Eagle Crest Financial, Kimball Electronics, WITZ, WQKZ, Old National Bank, Kinsendowek with Merrill Lynch, and WBDC, WJTS. Also, thanks to our Bear sponsors of Jasper Group, Freedom Bank, OFS, Master Brand Cabinets, Springs Valley Bank and Trust, and the City of Jasper. Thank you all and have a great rest of your week.